My mom was mad that Kenny Rogers was stuck because she couldn't play the Barry Manilow 8-track.
Barry Manilow, and then road tripping with the parents, and you only got Barry Manilow's greatest hits, and it's like, I cannot. One more day.
Welcome back to the Futures Edge podcast. I'm Jim Urio, as always, the brains behind the operation and executive producer and co-host, Bob Icino. And it's the first Friday of every month. So we have the chief strategist from Path Trading Partners, owner of many dogs, wearer of many tie-dyes, listener of Pink Floyd and Grateful Dead, Mike Arnold. Welcome, Mike.
No, thank you very much. Thank you. That's man of many words here.
Yes. How many dogs do you have? 5, right?
5 dogs, 5 rescues.
Wow, very nice. And I have rescues too. And my friends who know me very well know that it's not because I'm a kind soul. It's just because they're cheaper. And as soon as my family said we need a dog, I went, and as Bill Burr said, I went and got a free dog. But you're probably better than that I am.
Actually, you still have to, didn't you have to pay an adoption fee or something?
Yeah. Now in Illinois, they get you. You have to pay like a $300 adoption fee. Then you have to pay a $150 chip fee or something like that. Yeah, Illinois is making it ridiculous to adopt dogs.
Only in a place like Illinois can you have to actually pay to save a dog's life.
Exactly.
Oh, I thought the chip fee, I bypassed that. I just gave my dog a thing of Pringles.
Nice. Which, by the way, I've broken
horrible.
the rule on that stupid chip thing in Illinois with every dog I've had. I always say, yeah, I'll get them chipped, and never have. And they haven't come after me, but it seems stupid.
To that end, I used to get dogs from breeders. My last 2 are rescues. And to that end, here's the way around it for anybody watching. Can I foster them for a little bit and then change your number? That's what I do.
Oh, yeah.
When I like the dog, I change my phone number.
Just keep the dog, right?
They don't ever come and find you. They're happy the dog's happy.
Good. And the whole thing with chipping the dog, how about just train your dog not to run away? The food's in my house. The food's not out there. Why would the dog run away? Yeah.
Some might say it's an mRNA. Nah, never mind. I can't even say it.
Speaking of which, we are having the inventor of the mRNA vaccine on our show on January 27th. We are looking forward to that, Dr. Robert Malone.
It's going to be fun for us to try and tie that into markets somehow. We'll
figure it out somehow. We will figure it out. Let's talk about those numbers this morning first, before we go into the technical analysis. This is a big day. This is Friday. What day? Friday the 6th, maybe? But unemployment came out today. ISM came out today. Just on Wednesday, we had the JOLTS number, and we had the other ISM numbers. So nothing could be more confusing right now.
I agree.
The job numbers look stubbornly high, stubbornly good. Although when you dig into them, they aren't as great as they looked. And Bobby, I want you to comment on this too. Yep. A lot of that was part-time shit in that NFP headline, and wages were down, which was interesting, and revised down from last month. And ISM prices paid way lower, new orders way lower, ISM services way lower. Is that what the stock market like today, Bobby?
Yeah, I think so. And I want to tell for everybody who's listening to this that has not been an active trader for as long as the 3 of us have. Jimmy talks in Trader Talk. So when he says wages were down, he means that the rate of change was lower. And same thing, we had this early on in the podcast talking about inflation, rate of change versus actual CPI. Average hourly earnings was still up, but it was lower than expected, lower than last month. And last month was revised lower. Those are rate of changes. So wages were still up. I definitely think that's the part of it that the market liked. Also, the participation rate was up and the unemployment rate was down, which doesn't usually happen when the participation rate goes up. So it seems like jobs are getting created with lower wages. That's what this particular set of data seems to be implying. The bond market, however, still implying that the Fed is going to slow down and that the economy is going to slow down. And I think that might be sort of the next step in what happens here. In other words, if The bond market is now expecting a bigger slowdown because wages, I mean, rates were down double digits today, except for the 30-year, which was down like 7 or 8 basis points that's on the yield side of things. It might be implying that the Fed has gone too far already. That might be what rates are implying. And you've maintained that for quite some time, Jim.
I believe that to be true. I believe that once the yield curve inverted, and once we realized how big a mistake the Fed made on the other side, on the easy side, a year and a half ago back in June, which I know I harp on this all the time, but in June of 2021, CPI was already printing over 5%. The housing market was inarguably on fire. The Fed kept the foot on the pedal to the metal. They kept buying bonds. I think that they either feel terrible about that or at least realize they made a mistake. And now the likelihood is that they err on the other side. And I think the bond market told us that from the beginning. In July, I believe it went inverted, maybe even earlier than that. And now it's inverted to what? Like almost 90 basis points, right?
Yeah. Well, no, 2s10s was, I think, 77 maybe or 71.
See, I didn't have it up on my screen. I just heard somebody say it.
At last read, Mike, where is it now? At last read, I had it actually at 71.
On the yield curve?
Yeah, the 2s10s inversion. I had
It's
last reading.
69. It's 70 essentially.
Okay. And everybody remember we record this on Friday afternoon. So there's something else, Jimmy, so a lot of people, and I'm in this camp, believe that the Fed is going to be a little bit more aggressive still than the market thinks, because I'm going to steal something here. Okay. There's Randall, I think his name's Randall Krosner. I hate that I'm butchering his name right now, because he said that there are market participants that are believing that we're going to have an immaculate disinflation. In other words, disinflation that doesn't harm the economy. Different word for a soft landing, I guess. But for the first time in basically this cycle, we have the balance sheet shrinking. Quantitative tightening is actually taking place. We have no more negative yields in terms of sovereign debt, right? Everything is positive that's per Peter Bookvar's tweet, who's been on this podcast. So there's no more sovereign debt that's negative left. And when you take those things into account, if we're getting a soft landing, then theoretically the Fed can spark the economy just as quickly, because they're the cause of the little bit of depression that we have. I think that's what they think. We don't know if that's going to be the case or not, but I think that's what they think.
So that amazes me. And the quantitative tightening, for you guys who might not understand as much out there, the quantitative easing part of it, Fed creates money, buys bonds from the treasuries. When quantitative tightening happens, they're not actually selling those bonds that they own. They wait for them to mature. So the $1,000 bond they bought, they get the $1,000 back from the Fed, from the treasury. That just disappears the same way it was created. And then the treasury needs to go out and borrow that money again. So it definitely puts pressure on the assets and supposed to make rates go out higher. Michael, do you have anything to add before we move on? Oh, by the way, before we even talk about the stocks, by the way, no, that part actually can fit in with technical analysis. Do you have anything to add to the fundamental talk, Michael?
Not really to the fundamental talk, although I just think we should just get rid of the Fed, period, and then we wouldn't have to have this discussion and let the markets decide.
By the way. Amen. Yeah.
I'm trying to micromanage all this stuff, and then they say stuff like, well, we're trying to figure out the effects still of, this huge balance sheet and everything. I'm paraphrasing, but, we're trying to figure out the long-term effects of this. Well, shouldn't you have known that before you inflated, blew it up as much as you did? I mean, literally, it's my big problem is you're trying to micromanage a huge economy by looking at data points and then figure out exactly where the exact number to put a rate is in the short term and everything else. Let the market friggin' decide. Yeah, and the argument on the other side is, well, it balances out. It reduces some of these shocks. Well, I don't think it does really, because look at the friggin' markets. We ramp it up all the way because you dump trillions into the economy, and then you tighten it back out, and you dump it back down. Just let the markets decide. Please stop trying to be smarter than the collective market.
Amen. Amen. There's no truer words were ever said. And to add a little bit to that too, is as they flip the switch on and off, the people they're running roughshod over are the people who are who need a good market the most. You know, they mom and pop businesses are going out of business when they raise rates up, and the ones it's just ridiculous the way they do it, and they play God in this. And he sits back and says, "I want to create slack in the labor market," and to him that's an equation on a whiteboard. To people at the lower end, that's their jobs he's talking about. It's a whole bullshit system. I agree.
I would say that
Like,
it reminds me of people who, so on both sides, whether they're easing or tightening, right? Regardless of which monetary policy stance they're currently in, they remind me of people pushing to see how far they can drive on E. Right? We all did that in our younger years. I on occasion still do it now.
oh, drive on E. I got you.
Right,
Right.
yeah,
Okay.
driving your car and you're below the E, you're below the line. This is before your car told you how much you had left. But I don't know about you guys. Both my cars now go to fill up the tank now when you get below 25 miles left. Right.
Yeah.
But prior to that, we all had those gauges, right? We're like, I'm on E, I can go a little further, I can go a little further.
And then
That's
you had the
what I
one
was doing when I
jackass
was
in your
young.
car who would always go, "Oh, you can go 15 miles just on fumes." But anyway,
I have to throw this in before we go to Mike's charts because Tim McLean, he's a personal friend of mine. He's a friend of the show, follows all three of us on Twitter, subscribes to this podcast, subscribes to our YouTube channel, Empath Trading Partners. He sent me a question and I wanted to ask it. I know my answer and I think I know Jimmy's, but be interesting to know Mike's. Hey, Bob, I hope all is well. Not sure who your guest is this week. By the way, it's the first Friday of the month, so it's Mike Arnold. But can you ask them if 90% of all the sell side analysts predict a weak first half to 2023 and a rebound in the second half of 2023, can they all be correct? Who wants to hit that first? My answer is no. They can't all be
my
correct.
answer is no too. And this scared me when I came to the realization, because up the last couple of weeks I thought, and we're talking about equity prices or macroeconomic condition. I think he's talking about equity, right?
Equity prices, yeah.
So my thesis was, and it's changed, by the way, it changed with the price movement today, was that if we broke through that channel, that I thought we were going to have one more down move that was going to take up about the first quarter, and then we were going to do well the next three quarters. But if everybody thinks that, it obviously doesn't happen. But what then I think does happen is that we have a much greater chance of us starting the up move early and then people trying to play catch up. Mike, what do you think?
I don't think they'll all be right. And I think we're going to go through more chop, and then there'll be a significant downside surprise. So, I mean, that's just based off this. It's just though with everybody still trying to chase everything, that's the bigger problem. Everybody's trying to predict everything. That's why I say I'm not smart enough. I just got to look at price action, which is essentially a number. And I can look at the number and I know the probabilities with things. So if the probabilities shift, I shift. Until that, it stays in tactical trading mode. We're still in a bear market from a systematic thing. And yes, you can get rallies, you can get rip your face off rallies, you can get massive declines. And until the probability shift, nothing really shifts from my perspective besides taking the shorter term trades. And if you're a long-term investor, you wait for the long-term probabilities to shift and you stop worrying about the day-to-day price action.
So that seems like a perfect lead in to putting up the chart, and let's break down the S&Ps.
All right, let me give Mike control of the screen. I should do that at the beginning of these episodes, don't you guys think? All right.
You might want to.
You should be able to share now, Mikey.
You know what? Yeah, there we go. Let me know when you can.
By the way, I
it.
just threw out there, I'm back to, in the new year, back to drinking a gallon of water a day. So I'll probably have to leave and go piss at some point. Go ahead.
I'm doing that because you're doing it. I've started doing it as well. Seriously.
It's rough at our ages, man.
It sure is. I try to do it. I try to front load it too, because I don't want to be pounding down drinks at 8 o'clock at night, because we all know what that happens when you're 57.
My last one for the day.
Yeah. Mine too.
Hey, Jim.
Mm-hmm.
Would you mind if we started, we talked about the yield curve a bit. Would you mind if we start with a quick 10-2 yield curve chart?
Absolutely. Go right ahead.
And the reason I want to start there is because, as a lot of the research that I've done and other people have done shows, once we start accelerating back towards zero on the inverted curve, and then especially get above zero and go, 25 to 50 basis points, you can get some it favors actually a decent market pullback. And then, which generally coincides with some kind of recession. And then we put in a longer term bottom, and then there's great or good buying opportunities. Why I'm bringing that up right now is the 10-2s. With today's price action, we actually hit a key level, which signifies a potential weekly double bottom. Now, it would have to get a yield curve. This is the 10-2s again on a closing price back above minus 46.9 basis points. So roughly negative 47 basis points. And then we could start to see if that triggers, then we could see the rapid steepening, because the full target on there essentially takes us back to negative 10 basis points. So that could be the trigger for a major steepening. Now, this is a weekly pattern, so it doesn't have to trigger anytime soon, but we do have a potential steepening pattern in place.
Can you tell me what
Just
the trigger is again? What do we look for as the trigger?
We're looking for a weekly close. This would be a weekly close above it's at minus 47 basis points on the 10-2s.
Got it. Okay.
Interesting. So that's a little key thing, because if that triggers, let's say we rally and this still triggers, I mean, I'll be prepared for a potential significant reversal move at that point. We don't know what the markets are going to do meanwhile until they get there, but that's a very key data point people can write down. Now, if the double's invalidated, when I'm on in February, I'll let everybody know, but until then, it's a valid level.
Got it. Love that.
Okay, so S&P. I'm going to focus on, if you don't mind, some longer term things, because as I said, we're still in tactical trading mode. So, which means to me, yes, there will be bullish breakouts, there'll be bearish reversals within an overall still potential bear market. But instead of trying to chase, as I talked about earlier, with for a long-term investor, my level is still 43.70, a closing weekly basis above 43.70. That shifts the probabilities back to a retest of the S&P high area. So that's a long way off. Meanwhile, we've had a significant rally today. What are we up at the time of this recording?
Like 2.2 or something.
Let's see. I just have to flip my watch list now. We're up over 230 basis points, so significant rally. We're still technically in, what was that?
It's about 2.5%.
Yeah, still technically we're in consolidation. We have not broken on the S&P consolidation. It would need a close above about 39.35. If we get a close above 39.35, what's interesting is we should continue a minor rally, but 39.84 to 4,033 is a potential short-term topping area, and what's right in the middle of that, which is a key moving average, which not only we watch, but a lot of people watch, which is the 200 simple moving average coming in roughly at 4,000, or big psychological number again. So if we do break out of this range, we could see some more upside, but we have a fair amount of stopping points along the way. So is this just something oh, great, we're breaking out potentially, well, I'm just going to buy it and go to sleep for 6 months and hope my portfolio is higher? No, because there's a number of key areas that this could roll over again. What we need on the next major key closing area is that 4,033. We close above there. We probability-wise shift to see a retest of the highs from mid-December, about 41.30 to 41.80. So that's the only thing that makes us even more potentially medium-term bullish. And then the thing that makes us longer-term bullish is 43.70.
Can I jump in real quick?
Oh, yeah, you go, Bobby.
Just real quick. like this information is critical for 2023. Like a lot of people want to bottom feed, right? They want to find the low and get that big turnaround. But when Mike's probabilities switch, you can actually safely, and I'm not recommending this, I want to throw that out, I'm not recommending it, but you can safely take larger positions, because what Mike said, I think, and correct me if I'm paraphrasing you wrong, Mike, price action is a number and I can look at the number and see if anything changed. When you get these shifts, you can take larger positions and know that at least the price action's in your favor, right? As opposed to bottom fishing all the time with these tiny positions, you die by 1,000 cuts. Go ahead, Jim. I'm sorry.
No, my question was this: is that my thesis for the bull case was a settlement above 39.20 for the week, and then a continuation on Friday. When you say 39.35, it sounds like we're roughly on the same page, but my level's a little bit different. That's accurate, you think, Mike? But that's not my question, but that's relatively accurate, right?
Correct.
Okay, so now what I think would have been a much stronger signal was a settlement below, call it 37.80, and then a continuation of weakness from the next week. My point being is that it's a pretty distinct consolidation pattern that we've experienced over the last 2 weeks or so. If that broke, I thought it would have been significant, and it could have been some momentum downside. Is that correct?
Yeah, my first level was the 38.06 area on a closing basis. And you had the lows from December 22nd coming in at 37.8850. The
Right.
major line in the sand, though, that would have shifted the probabilities bearish in the short to medium term would be a close below 37.55 area, which again is still valid, which is going to be my second point. Because unless we take out the highs from December 13th, that level will sit at 37.55. So if we come up to that 200, roll back over, and then you get it. The easiest thing to do is wait for the weekly close. You can try to look at a daily close, 37.55. But that's my key line in the sand, unless we take out the highs from December 13th.
Okay. So in general, you still think the long-term momentum is lower, and what you would characterize these potential up moves as just being, bear market pops, correct?
Yeah, it's still tactical trading mode, which means I'm not getting married to long-term positions. I could get in setups to even things that might last 1, 2, 3 weeks. But I'm not going, okay, I'm just loading up my portfolio and going to sleep until 2024. And let's see where it ends, because it's actively managing a portfolio still. It's not just going, I'm just going to buy the S&P, or I'm going to buy the NASDAQ and just let it run. We're not there at this point. Yes, you can have rallies. Yes, I'm expecting rallies.
I let Bobby, I want you to interrupt this, but I said earlier, you said a significant down move at a certain point in time. Like, what from here, what do you feel is significant? When you look at this in the broadest terms, how far down do you think we could be 30, 40% down when we have finally that plunge?
Well, again, you're basing a percentage based off how much we rally in the short term. I would rather give my key levels just
good. Yeah,
I love that.
I'll give you the key levels. The next major on a break below the week of October 10th lows in the S&P. The next major cluster of harmonics and everything we follow in price action is coming in around 3,300. I'm just going to give the round numbers instead of getting down to the penny. That we break that, we're at about 31.75. Then the next major stop below there is not till 28.25. I'll just go, let's call it 2,800. I would not be surprised to see us easily get below, if things play out, between 31.75 to 2,800 level.
Bobby?
Couple things. So number one, if we get all the way up to that 4,000 and change level that Mike mentioned. So one of the things I don't like about my thesis for 2023 that I've stuck with through most of the second half of last year was that I thought we were going to have a decent sized rally, probably off of the earnings from the fourth quarter. And then the second half of the first quarter or the first half of the second quarter, we would have this collapse below October's lows. And I don't even think it would be a crash. I just think it would be another, managed down move because the stronger possibility of the earnings is over already. From that perspective, if that has changed, as Tim asked in his question, right? So many people think we're going below the October 15th lows that, as you and I agree, Jim, it's probably not, it's less likely to happen with the whole market to one side. So Mike's levels in that 4,000 range, that would end up where we were up somewhere in the range of 10.5, 11%. That would likely clear a lot of those people out. And I'm talking about on the year, it would be up 10.5, 11%. So now I kind of want that to happen. Not want it to happen, I shouldn't say that, but I kind of expect that to happen now. I expect the rally to align more with what you said. Now, again, because I don't believe the October 15th lows are the 2-year low. A lot of people look at the new year and they say, well, I'm at zero now. Who cares last year? Who cares? If we rally 10, 11, 12% in the S&P this year, you're still down 7 on a rolling 2-year basis, right? So they don't care. Art Hogan said, it's very rare to get a second down year. Well, if we break those October 15th lows by 5%, to end up positive in the year, it's only about a 10 or 11% rally off those lows, right? So it's likely to happen. Either way, it's likely that the year ends positive. It's whether it ends positive a lot or ends positive a little, right? So these things to me for active investors and people who have to worry about their portfolios over the next couple of years. So not talking to 30-year-olds or 40-year-olds here, probably not even most 50-year-olds. Is, yeah, I believe this year's probably going to end positive, but I would like to see us get above the 200 and get into that sort of 4,000 level range in order to kind of clear out some of these people who are like, saying that there's just such a large volume of people saying that we're going below those October 15th lows. And I feel like Mike and I have been saying it for quite some time. I'm sure they're not listening to us. I'm not trying to take credit for it, but we're not alone on that train anymore. We're not.
Right.
That bothers me.
Can I give you a quick to tell you, because I kind of want to know what you think of the options trades I've been putting on over the last couple of weeks. Is that okay?
Yeah, that's a Mike question. Go ahead.
Okay, so here's, and for both of you, here's what I've been doing that I think is pretty, you know how I like to pat myself on the back on certain structures I put on. So I've been selling a put fly to the downside, like for instance, and I can't remember exactly what strikes I have on or even exactly what expirations. My account isn't in front of me, but I know that I have a few months in either, let's say June or March options. And so I sell the 3400, well, 30, let's call it the 3450 put, selling the top put, buy 2 of 50 ticks lower, 3,400, then go 150 ticks lower on the fly. So I'm selling a fly that's 50 by 150. So I own the middle 2, which, so if it fills out the whole way, I make 100 ticks, 150 minus 50. But then I'm selling like the 2,200 put as well. 2,200, I said, because ultimately that's where I want the damn thing. And I don't care if it's June. Bobby, do you like that trade? Or Mike, do you like that trade?
I'll go first, Mike. I always like that your trades are stacked like that and you try to finance them as much as possible because, as we all know, the theory of people who've traded options successfully for a long time is you don't make money buying them. I don't think we're going to get to 2,200 either.
Good.
So I could be wrong. I mean, I don't think this is the market environment where we get to 2,200.
No, and that's if we do, that's where I want it, right?
I think it's coming in the next decade or so, but I don't think this is the environment that gets us down there. Mike?
Yeah, I really like the trade. Especially, I mean, it's going to take a lot to get to 2,200. My major line in the sand, we get major warning signs before that. 1,800 is like all out, full blown disaster mode. When people say the market's going to zero, no. First off, it's
doesn't.
not going to zero.
As soon as we hear that, we got
So my zero level is, so what I equate to markets, like when people say markets going to zero, my zero level, which is full blown disaster, absolute wipeout, blood in the streets, is 1,800. So, and would I be willing to own it at even 2,200 with limited downside? Yeah.
That's what I thought too. That's what I thought. And I've only done it on times when skew was popping and it seemed like those out of the money puts were being bid up a little bit. So again, and that only hasn't happened very much. Vol's been weird in this whole break lower, but there's been a couple times where we've seen a little bit of a spike like that. But anyway, let's move on. What do we want to hit next?
We have a request for crude oil. I request.
Can we hit NASDAQ real quick?
Yeah,
sure.
The reason I want to hit NASDAQ is this is another great example. We might have a short-term bullish tactical trade, and I'm going to give it a little extra leeway from the true trigger point just because it's against the daily rotation zone, but you get a NASDAQ daily close above 11,204. The targets, it's so funny because the target's based off the harmonics. The first target, which is stop reduction traditionally, 11,400, technically 11,393, it's right at the 50-day exponential. The next target, coincidentally enough, 11,496, so just shy of 11,500, is by the major breaking of support that happened in mid-December, Thursday the 15th. And then the final target, 11,605. So yeah, we could have really nice little bounce to theoretically, if again, close above 11,200 in the NASDAQ. So that's just something I'm keeping an eye on from a tactical trade in the
Where
short
is it right now,
term.
Mike?
NASDAQ's right now at 11,104, so 11,100.
So you like a close above 11,200 is what you said is your trigger.
Correct.
Love it.
Correct. By the way, I'm just going to give what's interesting, the NASDAQ does not tip probabilities for long-term until 14,630. Short-term, it doesn't tip probabilities besides that little trade I gave with potentially the targets being 11,600, but even the medium-term probabilities to retest the highs from December 12th, the week of December 12th, don't trigger until we get a weekly close above 11,743. So even on these rallies, unless you see some follow through and I'll get a weekly close above 1143, we could just peter out after the rally.
Bobby, got anything with that?
Yeah, I like that short-term trade. I think it will have a lot to do with some of the data that's coming yet that I don't really want to go into, but I mentioned this to Mike on our live stream this morning. I'll mention to you as well, Jimmy. I'm working on a thesis that involves tech. I'll probably bring that up maybe next time we have Cameron Dawson or somebody like that on, because it's more of a longer term thesis. But tech. The NASDAQ was the weakest of the four indices this week. If you look at a weekly NASDAQ chart, you're looking at a red candle there, even though it's a positive finish versus last week's close because of that gap up. Yeah, so I like the short-term trade, and that's something Mike talks about a lot, is that you can have short-term positions around your longer-term thesis, and this is one of those on the daily. But you look at that weekly chart, red candle, but we did close higher than we closed last week, I believe. Although we're not closed yet, are we? Oh, we might be. What time?
No, we're not.
Yeah, we just closed. 8 minutes ago. Oh, no.
Oh, well, the futures aren't closed.
Futures are not closed, right?
So the NASDAQ is the weakest, and there's a lot of people out there that believe this is just going to be a NASDAQ or a tech earnings recession. I'm not a believer in that, but we'll have to see how that plays
Do you
out.
believe in if the Fed all of a sudden realizes that they've gone too far within the next 2 months and starts talking about pause or even implies that a ease at some point is possible, do you think the NASDAQ screams?
So I love this question because the initial thesis, I believe, is incorrect at this point. Could change.
I didn't give a thesis. I just asked a question.
Well, you said if okay, that's fair. That's absolutely true. That's fair. You did say if this happens or if they give indication. I'm just so hypersensitive to it. Yes, I do believe the NASDAQ screams. I just don't think the earnings will necessarily support a screaming NASDAQ. But the thesis that I'm working on is I do believe tech is the way that you make up portfolios if you're behind in your retirement portfolio over the next 3 to 5 years, because I think tech is going to continue to suffer. Look, if you look at some of the tech companies, and I've said this before, some of the tech CEOs, they've never existed in a market where money actually costs something. So if you did take the pandemic out, tech's never been tested. If you take the pandemic out, and not tech in general, some tech, I'm not talking about Apple or Amazon or some of these companies that were around during the tech bubble. I'm talking about companies that are 10, 12 years old that drive so much of tech rallies, so much of the NASDAQ rallies have never been tested. And the pandemic was not a test for them. It was a test for the traditional market. Wasn't a test for Uber, wasn't a test for Zoom, wasn't a test for so many of these companies. I'll throw Tesla in there. They've never experienced a market where money costs something. And I think that matters. We'll see if it does. And we'll see if money continues to cost anything or not.
That's the big question. That's where you and I disagree on occasion.
Yes, we do.
Right?
We
yes.
do.
All right. Let's move to oil.
Yeah, we have requests for markets, and I think we all saw that on Twitter. So,
and I liked the request. It was oil, gold, and silver, basically.
Yeah,
right?
and I like Tim sent a question. You can all send questions before we record as well. You should all know that you can do that, and we'll address them.
All right, oil. Still, we've hit from that weekly double top. The first and second targets have been hit. The second target, roughly $70, $70 area. We got down to
Michael,
70.
Michael, could you explain that like in detail? We set the double top and then we hit the target.
Sure. We had it mathematically, and they don't have to be exactly the same height. There's a mathematical ratio between them, but these two tops between the week of June 13th of 22 and the week of March 7th of 22 came close enough to make what, from our technical analysis perspective, a double top pattern. Once it broke below or closed below the low of the week from Monday, April 11th, it was triggered. And the targets, the first target, I'm just going to give the rough area of about 77.50. The second target right around just in front of $70. And we got down to 71. And I even said we had a little divergence play. This is where I'll fine tune some things because I'm not going to sit through a lot of volatility to eke out 50 cents. So we've hit those two targets. The final target, which has not been invalidated yet, is 62. I am focused on a final target of about 65.50 in front of that 62 area, just because you have that a magnet of the weekly 200. So we still have a downwards bias in there. The only thing that eventually unwinds that pattern in the short term, or more in the medium term, would be a weekly close back above 103.58 at this point. However,
and why 103.58? Where do you? Oh, okay. I see.
That is a harmonic. That is a harmonic level.
Oh, got it.
Oh, that is a key harmonic level that would say, okay, the trade is over. It only worked through the first and second target. However, we do have a potential another short-term, and this would just be a short-term bullish pattern. It would need a close above a high of 81.50. A close above 81.50 gives us short-term targets of right around 86.75 89.50 and 92.25 areas, not even back to the daily 200. So overall, I'm choppy to down still, unless that little double bottom pattern triggers, and then I am choppy to up in the short to medium term before another potential rollover. The only way I will stop watching for a rollover play is on a weekly close above 103. You could just say 104, just round it up at this point.
So what would be a trigger for a trade to you? In what direction?
A trigger for a trade would be that on a daily close above 81, let me see, 81.50.
Okay, and then your target would be what?
3 targets. First target,
Yeah.
86.70. Next target, 89.50. Next target, 92.25.
Perfect.
I want to point
And
something
people
out
were
on this,
watching.
if I could, Jim, that,
Yeah.
you know, again, Mike's, this bigger picture trade is over level. I think you just rounded it up to 104. Is that right, Mike?
Yeah.
Okay, so he rounded it up to 104. People get confused all the time. It's like, well, I thought you're bearish. Why did you go long? Well, I went long with a target that are all below 100. So you can trade in between a larger pattern. This pattern triggered, as Mike said, in October, and it's still active, right? And this is one of the, you know, we talk about the CME micros, that bigger pattern, you almost have to do that in micros because it's nice and small and you can just leave it alone and let it work. But I mean, this is from October to now, and it still hasn't reached the full target, although it's reached the first 2.
Nice.
And
let's
just say you're the long-term trader, you're still net short oil. If you're a short-term tactical trader, you can trade around a core position. Overall, I'm short, but you trigger a bullish position, we could rally up. So I take off my short, go long or short-term long, and then reestablish my short on some rallies.
Perfect.
The way that I always did this is the short-term positions. I always did larger position sizes to them because they were short-term, so they had less risk. And I would just do those trades, and it would look like I exited the long-term trade in my account, but it wouldn't look that way in my spreadsheet. In other words, I'm still tracking the long-term trade, but my short-term trade, first in, first out, covered it. And then I reestablished the short. And it gets a little confusing if you don't manage it that way, like with your own Excel spreadsheet to watch the trades you're in. But
makes perfect sense. Yeah. What do you want to do? Gold?
I don't think we have any way to look at housing technically, but let's look at.
No, I know that guy. I was thinking of that too. And
I don't know how to do that. Maybe I'll look at it for next podcast, and maybe we can send it to Mike for the beginning of the month. If I can find, actually, if you're watching this, tell me what housing you're talking about. You're talking about new home sales, pending construction, existing home sales, this and that. We'll find a chart and ask Mike to analyze it for the next podcast. But that's what.
Or even the home builders.
Yeah, even the home builders. We could look at their chart, their stocks. Actually, we could probably do one of those on the fly. But let's look at the weekly euro chart, because I have something I wanted to ask Mike on that, where I might, depending on Mike's answer, I might actually put on a position in the futures, but we can look at it here because it goes the same way. So look at that weekly euro, Jim.
Let me get to the futures. You want the futures?
I mean, it looks the exact same, but that's fine.
The cash triggered a pattern, the futures didn't.
Okay.
So that's what I'm asking.
Okay. I would be doing it in the futures because I'd be using the micros, but I don't care. We can look at both because I haven't done it yet.
I mean, we'll
by the way, Michael, when that happens, do you just trust the market that has the bigger volume, the more participants? Is that when something disagrees?
I revert to the cash or the because why the futures still have the closing windows. You can get interesting settlements in the futures. So I found if I'm going to trade something and there's a disagreement between the futures and the cash, I will err on the side of going with the cash.
So what I wanted to ask you, Mike, was, okay, so you see there's that area, the end of May, beginning of June. and you have levels there based on what I'm not even necessarily asking that, but we had a first cross weekly rotation zone, and then we had a pullback to the 8 EMA. Now, for people who don't know, the rotation zone is the 8 exponential and the 21 exponential, and also they correspond to the chart you're on. Correct, Mike? So this is a weekly 8 EMA and a weekly 21 EMA. And we pulled back toward the 8 and at the same time pulled back to the 50, and they held. So I want to know, see if you're seeing the same thing I am, where this to me is not necessarily a clean long signal because I didn't calculate out stops and I didn't calculate out targets, but I like the signal, especially when you look past that peaking area in June. I'm sorry, end of May, beginning of June, there's a clear path on a weekly that you can trade into as well. But so I want to see what your overall view of that is.
Overall, it's today triggering a modified %B buy signal on a short-term basis. So I'm watching for a break above 107.80 roughly, and the next minor target is about 108.80 to about 109. And then a significant major target area is 109.80 to 110.20. Now, this is an aggressive buy pattern. Why? Because weekly cycles are at a top and rolling back down, and it's severely overbought on a weekly basis. So I'm watching for this buy pattern to actually form a more substantial topping pattern in the euro.
Okay.
I got no
Okay,
questions.
so-
We said a lot there, and a lot of what we said, like, for example, a clear path. Okay, that's something Mike and I have used for a long time. I used to call it space. You can kind of point that out with your mouse there, Mike, is Jimmy, markets and I started researching this even before I met Mike. Markets love to fill those consistent colored areas. So in other words, if you have 4 or 5 or 6 candles in a row of down red on the way back up, the market likes to fill those. Okay. Same thing in the up move. Like if you look just over the last 5 weeks, you have a clear path. If we were to break lower, you have all those candles that are the same color.
Oh yeah, I get
That's
what
a
you're
clear
saying.
back down, and the market likes to fill those. And all 3 of us spend time on the trading floor. Jimmy, if you remember, you'd be talking to locals or brokers, and they'd be like, "Oh yeah, I got short at 101.56 and it killed me, so I'm not trading that level again." Even though it's not the level, right? It's whatever happened, but traders tend to back off away from areas where they are hurt before. So it ends up with these little mini vacuums of space. Again, that's why I used to call them space, but we call them a clear path now because the market travels through what is essentially a clear
I
path
love that.
of no recent resistance or support. Now, they're never smooth, right? They're never smooth, but they allow you to kind of find targets and see if anything conflicts with those targets.
That's interesting. I like that a lot. Yeah. Let's move on to gold.
Yeah.
Gold.
Thanks for that, Mike.
All right. Gold short term, looking for a topping pattern. So it's just trail from any longs. This is something that's trading around a core position. I've talked about that a lot in gold. Why? Now, hold on. What shifts it for me? I'm going to give my key line in the sand, a weekly close above 1906. Above 1906, it's shifting from more tactical trading to more of watching for the retest of the 2000 to about 2080 area. So it would be more so letting stuff run to the upside. Other than that, we are getting against some key areas, 1880 to roughly 1900 for a topping pattern, where then I'll be watching for a pullback. And as long as the pullback in this level, if we keep rallying, will change, but roughly the pullback area, which interesting enough corresponds with the weekly 200. So you can roughly, if the level changes, just watch the weekly 200 simple moving average. a close below about 1714 is the only thing that invalidates the bullish bias in the near term, even with a pullback.
So tell me this. You said the bullish bias in the near term still. So can you break it up to me for go short term, medium term, long term? Your bias long term is still bearish gold, correct?
No, my bias long term is still tactical trading, unless which right now the trend is up.
Right.
So it's choppy to up. We get a weekly close above 1906. It shifts to more weekly. This is where I want to be less aggressive taking any profits and more aggressive adding on pullbacks. Right now, short term, we're looking for a topping area to come in. So would I be an aggressive buyer here? No, I'm looking for a pullback in the short term. And the only thing that invalidates the thesis is a close back below 1714.
Oh, and then it's bearish more than tactical.
Yes, then we should retest the lows, which we made a technical triple bottom between September, mid-October, and end of October. We made 3 lows right around that 1625 area.
Cool. Bobby, got anything for that?
No, gold is my big call for 2023. It goes right along with some of your silver positions that you've talked about a lot, Jimmy, as well as to a certain degree your copper thesis. So I like what I see here because it's my call for 2023, not for this week. So
right, and mine too. And again, you guys know I've been beating the drum on metals for months now.
Yep.
And again, this is not just I'm looking for ways to trade it from the short end, but these are medium and longer term positions too. My call for 2023 and the next 5 years.
Yeah, and I'll say something else really quick is Goldman Sachs put out a note the other day talking about how this past couple of years we've seen more supply disruptions for copper than we've seen over the previous 10, and they expect that to continue. So it just all fits.
They're always ripping me off, those Goldman assholes.
Real quick, because this podcast will be out before we do have a potential, and I said I was watching for a short-term topping pattern with this substantial rally today. We formed a double top pattern potentially on a 4-hour chart, which I don't normally go into, but it's not going to trigger before this comes out. So if we get a close, and I just wait for a daily close below 1829, we could start the pullback, but that's a pullback that I'd be watching for buying opportunities, this is a short-term topping pattern within a longer medium-term uptrend.
Right.
Got it. Makes sense.
Silver or copper?
Silver, baby. Silver.
Again, silver's more pulled back into some neutral territory. So we did get a little bounce today. It wasn't enough of a pullback though. I'm still watching for a slightly bigger pullback in silver unless we break above about 24.75. A key level though for silver that I need, silver's even more tactile trading than gold. I need a close above 25.50, and then it shifts into more longer term bullish position. Until that happens, it's still unwinding into rallies at key levels and then adding on pullbacks.
Did you say 24.50 or 25.50?
25.50.
So a settlement above 25.50, and to paraphrase, could mean green pastures for the long term.
That's where it starts shifting, and I start focusing on a retest of the 28.75 level to the $30 level.
Got it. Okay, that makes sense to me.
Coming my way.
Yeah, exactly. Well, again, I always talk about my silver position. I'm uncomfortably long silver. I have been for 2 years, and again, it's fine. It's part of a longer term thesis about the stewardship of our currency that I'm very scared of. And so I've made a lot of that back over the last couple of months, a lot of what I was down. So I'm happy about that.
There you go.
The only thing, and I always like to put this out, the only things that shift probabilities back to bearish in the short term is a close back below 2017. So you just a $20 area, but it would have to do a lot of technical damage because even the breakout area at 21 would have to be broken before that. And there is a lot of major support right around 21.20 to 21.
Can we do something? Here's something I might want to do, a new thing. I'm going to ask you long-term, medium-term, or short-term, and you answer either tactical, bullish, or bearish. And this is just, like a kind of a broad thesis. So short-term.
Short-term, I'm bearish.
And medium-term.
Bullish.
And long-term tactical still?
Long term to get into, I need that close above 25.50 to confirm the probability shift.
Okay, so you think on the short term we're going to need a pullback, and that's a spot to buy for the medium term to really paraphrase what you're saying.
Correct, and I should say choppy to bearish in the short term, because if we base sideways, we could technically form a breakout pattern, which then would be a short term, then shift into bullish without a more substantial pullback. Remember, there's two ways a market corrects. It can either pull back or it can correct by moving sideways and base and then break out from that sideways channel.
Cool. And you people who are listening, I want to make something perfectly clear. When I ask those questions, it's strictly for my own benefit because I trade off these levels. I forgot for a second that we even have an audience on this. I just want to know what Mike's doing because oftentimes he talks me out of a thesis that I have, and it's usually with a good result. And I appreciate that very much. You want to go copper?
Yeah, I love copper. Oh, and the price action day, I've been waiting for this since I have not had a chance to look at it in the last little bit.
Wasn't one of us beating the copper drum really hard for the last couple? I can't think of who it was. Anyway, let's just go on.
I don't know, but we had the bullish pattern triggered back in the beginning of November.
Jimmy, when did you speak on copper in New Orleans?
October 12th.
Yeah, you told them.
And remember the chart, the chart has not changed since the chart that we worked on back in October. So these levels, it did trigger until November, but the levels have not changed since the beginning of October when this chart was put together. See, it's just, it rallied up, it's pulled back a bit. The pullback did not invalidate the targets they were solidified on Thursday, November 10th. They were triggered, but reward to risk wasn't proper. They were triggered on Friday, November 11th. And then anytime after that, you essentially got good reward to risk. We stalled out at the 200 with multiple runs into it. And today, and I've talked about this on the YouTube channel, was watching for this break above the 200, which was softened multiple times, now ramping up. We still have the same targets in place that are now reinforced by short-term harmonics. 405 first target, next target area 416 to 418, and then final target 432. What's interesting, you get a close above 433. It then shifts the probabilities again for a retest of 480 to $5. So this is, we don't normally talk about rolling a double position because it's got very specific targets. But if this, I would be taking some off it, especially the second and third key target areas. But then a close back above 433 could be a re-add of something, or just whatever's remaining, let it run and keep running for potentially 480.
So Bobby, what I'm seeing on this chart is every line that he draws on the upside is one block closer to the beach my retirement home is going to be. Do you like thinking of it in those terms or no?
I do. So one thing that I always like to tell people, and I'm pretty positive, Mike agrees with me, is that a target isn't necessarily where you exit a trade or exit an investment. A target is somewhere where an action is needed. So since this is a good sized position of yours, I would pay close attention to these targets, because as we reach them, if we reach them, you will likely need to create some sort of action. And whether that means to scale your position back, whether it means to add to it, whether it means to take your break even up or take your stop up, or, that I would consult Mike in the coming months. But
I
a
will.
target doesn't
And I
necessarily mean-
joke
you
about
do.
being all in.
I know.
I'm never all in on
You're
anything.
never all in.
Because
I know you well enough.
because
But like it
if
very
I'm
much,
wrong, I don't want to. Yeah.
it
You
very
go.
much applies to that longer term crude position that we talked about, longer term crude trade, because we might click first and second target is reached. So people will be like, so are you out? No, we didn't say first and second exit is reached. Oh, then you're buying more, no, or selling more. No, it doesn't mean first or second added shorts is reached. A target is something where, based on the way that you trade, actively invest, an action is needed. That's it. You decide on the action. We're not financial planners.
Yeah. Okay,
And
I'm heading out.
also,
Oh, you go, Michael.
it also, in my stuff, because you can get things depending on how it gets there, how fast it gets there, can change the action that's needed. So,
Oh, wait, can you
okay,
go into,
like
can
if
you
this were
elaborate on
just
that a
to
tiny
break,
bit?
Yeah.
what was that?
Can you elaborate on that? I thought that was fascinating.
Sure. All right. Let's say we just muddle along and it takes another month to get to that first target of 405. That's very different than if we scream there next week. All right. One, it's going to change. Now, I'm going to take an action at that 405 level. However, how we get there determines, like, okay, how aggressively my stop's moving up. How I'm going to use other technical indicators. Did we get there and go to major overbought and expect a more significant or a less significant pullback? So that's going to go into my stop placement and my modification. If we're just screaming, also, let's say we then scream through, let's just hypothetically say I was poised to take profits at 405, but we get there in another day, I'm going to let the thing keep running. I'm going to raise the stop, but I'm going to let the thing keep running. If we sit there and take a month and it's barely grinding higher and we get there and it's forming a double top pattern against that 405, I'm going to be more aggressive taking something off the shelf, because we could then substantially pull back. So taking an action, I already have my levels in place. Now, I might know roughly in my trading plan, okay, this is normally where I raise my stop, or this is normally where I take profits. But if we're breaking out with huge momentum, I'm still going to take an action, but it might be a modified action to say, I got to let this run a little more. Instead of taking more off the table, I'm going to let it run because we got severe momentum.
I love that. Bobby, got anything else before we cut it?
Nope, I'm good.
All right. So you guys have a great weekend.
Oh,
Okay.
I do want to add one more thing, and I'm sorry. I want to let people know, for whoever stayed on this long already, and you should have, we're going to start pivoting a little bit to do some more non-financial stuff, but we'll always tie it into financial. So if you see a guest where you're like, why are they talking to him or her? It'll tie into economics in some way, shape, or form, into markets in some way, shape, or form. So don't give us time to work through that, because it's going to be really, really good.
It's going to be fun as hell too. We're going to have some
Yeah.
great guests. It's going to be a gas.
It's going to be
So
great.
it won't be time wasted. All right. See you, boys.
See you guys. Thanks, Mikey.